Earnings season in full swing at this point. Joining us right now to talk about what investors can expect is Anastasia Amoroso. She's global investment strategist at JP Morgan Private Bank. Also, Mike Santoli, CNBC's senior markets commentator. Anastasia, you're looking at what's going on, and you think that there's the chance that the markets could really pick up some growth if we continue to see earnings coming in with better than anticipated numbers.
Yeah, I actually think the market currently is not pricing in the growth is going to rebound in 2020. If I look at the average forecast for 2020 GDP, it's about 1.7%. And to really translate into terms that we can comprehend on a monthly basis, it's about level of 50 on PMIs. So you're telling me that PMIs are not going to pick up into next year. That's what the market consensus was pricing in. And I don't think that's quite right. I do think that the monetary policy, which really moved into easy mode, is going to work with a lag. And by the first quarter of next year, by March of next year, we could actually start to see that pickup in PMIs. So if we do rebound from the sub 50 level to something like 53, 54, then that's what eventually is going to drive earnings reacceleration. And, you know, the market really cares about not just the level of earnings, but earnings revisions. And revisions have been cut down significantly. So to the extent that they start to get revised higher as the PMIs come in better, that's the source of upside.
Here's the thing. I agree with you on most of that, but I don't know that you're going to get too many CEOs who are on conference calls saying, hey, we're expecting great things for next year, because they're just uncertain about so many things that are still taking place. Even if the numbers are going to be better, I'm not sure you'll see too many of them sticking out their necks and saying that's the case.
No, I think that's right. I don't think you see that this earnings season. I do think you see that over the next 6 months, but you really have to watch the data rather than the corporate guidance. I think you're right. It's going to be on the conservative side. But I think what is encouraging about this earnings season is that earnings estimates have been cut down. Also, the number of negative pre-announcements is higher than the 5-year average. So it suggests to me that a lot of negative guidance has already been put out there, especially, by the way, for tech companies. So that makes us more encouraged on the potential upside and the potential beats from things like technology, for example. I would also say financials and healthcare are also two other sectors that I think could see upside as well.
Mike, what do you think?
Yeah, I think growth expectations that are embedded in the market have been beaten pretty low. So we're at a point, I think, especially through August and again with this little tiny pullback in October, where just normalizing investor positioning and sentiment and growth expectations, I think, gives you a little bit of a tailwind. So the market yesterday kind of suggested that. I mean, you were essentially, United Healthcare, as an example of a stock that just popped huge on, yeah, sure, good numbers, but because it was cheapened and because expectations got very low. So right now, I am pointing also, to the rest of the world, and European banks acting better. This idea that yields are lifting from very low levels, if you can believe that that has a little bit of force behind it, it probably does give cover to this idea that, and that's, by the way, I think why the terms of this trade truce don't matter terribly much, because to me, the most immediate concern about intense trade frictions was a hard landing in China, another leg down in global growth. If you have the data turning for the better, it insulates you against that outcome.
You think that's the case even if the China trade deal never actually is finalized or formalized or anything? There's tensions that are still popping up with the U.S. Congress saying they're in support of Hong Kong protesters, and China getting mad about that. So who knows where this goes? Yeah,
it's definitely not a done deal. And I think a lot of the optimism around a mini deal has been priced in, but I would say not enough optimism about actually signing the agreement and getting any sort of grand bargain, I think, has been priced in. But the thing that I would come back to is the election calendar that's going to be upon us. And with the economic data slowing as much as it has on the manufacturing side, I think there is a desire really from both sides to put some sort of a floor underneath this economy. So I suspect that the news flow on the trade front is going to be more constructive.
And then the other thing is, so the Fed, right, cuts twice. Market thinks you're getting another one, maybe a fourth. What was the pain that was extracted from the U.S. economy in exchange for a full percentage point of Fed rate cuts? Arguably not that intense. And so I think the market is trying to see through that and say, we might have gotten a little bit of a freebie here in terms of the domestic economy and what the Fed did in response to it.
Interesting call from Bank of America where they're saying the 60-40 portfolio, 60% equities, 40% bonds, is not the way to go anymore because yields are now so low that it's not worth it. You can get higher yielding equities.
Look, I think it's a very, very accurate call because a lot of the equities out there are paying more than the 10-year Treasury yield today. And as Mike was saying, a lot of the growth expectations embedded in the 10-year Treasury yield are actually quite low as well. They're consistent with that 1.7%. So to the extent that we see growth improve, you're not going to be all that well served hiding out in the 10-year Treasury, for example. So I do think that looking for yield in cyclical equities is actually a very interesting proposition. And take healthcare, for example. Here's a sector that offers you above market yield, whether you look at U.S. healthcare, whether you look at European healthcare. It has been beaten up quite significantly based, due to some of the regulatory proposals.
I was going to say, in some cases, it's a pretty good thing that it's been beat up because they're worried about changes that are coming from the politicians. And when you look at things like the Democratic debate last night,
right,
you'd have to agree that there is a huge risk potential for lots of these names.
Well, here's what I would agree with, that it is very unlikely that either of those sweeping changes are actually going to make it into law. Whether you talk about Medicare for all, whether you talk about drug pricing, these are really big and important proposals. However, the legislative odds of them getting enacted are actually quite low. So when I look at
Elizabeth Warren says she would do what she could with executive order. Like, she will take and run with that.
Well, you can do a lot with executive order on the regulation front, but in order to really pass sweeping changes, you need to have a sweep of both houses of Congress, and that is currently not the base case scenario. If you do get that, then I think we definitely need to readjust our thinking. But at the moment, if I look at healthcare, it is discounting. It is trading at a 20% discount to the market, which is at the depth of some of the fears we had about Affordable Care Act and prior instances of healthcare uncertainty. So a lot of this worst case scenarios in my mind has been priced into these valuations. I would say especially in the pharmaceutical space.